Joining us this morning is J.P. Morgan's Chair of Global Research, Joyce Chang. Joyce, it is always a pleasure to see you. Thanks for the time this morning.
Great to be with you.
One thing I want to get you on is sort of the disconnect some believe in the macro data versus the micro commentary, and that's certainly filling in nicely as we work our way through earnings season. What do you make of all that?
Well, I mean, we continue to see very strong government spending here. I mean, if you take a look at the last quarter, which exceeded expectations, you had about a 4.6% increase in government spending. So there's this real disconnect now on what we're seeing on the macro numbers, the third quarter macro data that was very strong. But at the micro level, we're looking at auto and credit card delinquencies that are trending at 20-year highs right now. And when you look at things like new car prices, that's risen by 30%. We're looking at just the cost of living really going up, particularly for lower income quartiles right now. And the last survey we did, 44% of consumers in the U.S. and Europe said that they were going to decrease their discretionary spending.
Yes, and that's been borne out in some of the other commentary out of J.P. Morgan this week, which is, I would argue, has been on the dark side. We've talked to Dubravko, we've talked to Marco about the peak impact of these rate hikes still to come and what that means for corporate demand, corporate pricing, the consumer. Does that mean equities have some tough roads to hoe?
Look, we do think that we're not in the soft landing narrative at J.P. Morgan. We still think that recession is a risk here, and that the longer that you see central banks remaining on hold while signaling that they're biased to hike, you could have a deeper recession that just takes longer to materialize. So we remain defensive over here. I mean, we still think that energy is going to do well here because of some of this heightened geopolitical risk, but we're recommending more sort of bond proxies like utilities, looking at staples. But I think the key risk we're seeing is that the high yields are here for longer, and we really don't know what this means over the longer term. I mean, we had a real yield target of 2.5% that we did not think that we would hit this year. But I think there is a risk of overshooting, and there's some underappreciated risk here. Like, I don't think there's enough attention paid to quantitative tightening.
What about the geopolitical risks, and if enough attention is paid on this? It feels like a tough one to get your arms around, not whether it's bullish or bearish for stocks or oil, but just the implications it could have on flows around different countries, the fiscal implications on the U.S. government, what that might mean for bonds, the dollar, oil. It feels like it changes a lot of things, but it's hard to see near term what that necessarily means for markets.
I think you're absolutely right. The problem is with the geopolitical risk, there's no end game for what we're seeing in the Middle East, for some of the U.S.-China dynamics, for what we're seeing with Russia-Ukraine. And that means that you've had a flight to safety. So you can see the stronger dollar remaining here, higher for longer, which is harder for longer for a lot of the emerging markets countries. And what we're really seeing is that it's crowding out some of the flows to other places. So we've seen big outflows from emerging markets, even as a lot of the macro data has actually held in pretty well for a lot of the bigger emerging markets countries, including China's stimulus. We still see the outflows because there is a flight to safety here.
Yeah, 10-year closing in on 4 3/4. Interesting. Joyce, maybe next time we'll talk some China as well, but it's good to see you. Thank you.